Gold isn't rising because it's strong. It's rising because the dollar is breaking. And by the time most investors realize that, it will already be too late. Looking at the financial landscape as we move through 2026, there's an uncomfortable truth emerging that most investors aren't prepared to face. Gold has been sending us signals throughout 2025, and those signals are becoming increasingly difficult to ignore. What we're witnessing isn't just another market cycle. It's the early stages of a fundamental shift in the global monetary system. The Federal Reserve has effectively abandoned its inflation-fighting posture, even though inflation remains 50% above their stated target. Their pivot back to quantitative easing under the guise of ensuring ample liquidity reveals a deeper anxiety about what's happening beneath the surface of the American economy. The tech bubble, the cryptocurrency mania, the precarious state of the banking system. These aren't isolated concerns, but interconnected vulnerabilities in a financial structure that's become dangerously unstable. Banks aren't expanding credit because they're genuinely worried about what lies ahead. No amount of liquidity provision from the Fed will change that fundamental calculation. When institutions start pulling back, flooding their balance sheets with reserves accomplishes nothing if they refuse to lend. What we're seeing instead is a desperate attempt to prop up Treasury demand, with banks being incentivized through regulatory changes to warehouse government debt rather than finance productive economic activity. The global investor base is reading the same warning signs. Short-term Treasury bills are selling, but longer-dated securities are struggling to find buyers at acceptable yields. This tells us that sophisticated money managers see the United States sliding inexorably toward a debt trap from which there's no clean escape. The Japanese market, historically a reliable buyer of American government bonds, is becoming less interested as domestic yields rise and the currency risk inherent in the carry trade becomes untenable. When Treasury yields at the long end break decisively higher, and the technical indicators suggest this is approaching, the equity bubble will face a reckoning. Markets that look tired and overextended today will turn decisively lower, and the cascade that follows will be severe. Banks holding stocks as collateral will be forced to liquidate positions to protect the value of their loans. Foreign investors, who currently hold more than $20 trillion in American equities, will rush for the exits simultaneously. Most won't make it out intact. Perhaps $5 trillion, maybe as little as half that amount, will actually be retrieved before prices collapse too far to execute orderly sales. This isn't speculation about some distant possibility. The mechanics are already in place, and the timeline could be measured in months rather than years. Anyone holding significant equity positions needs to understand that the risk profile has changed dramatically. What worked during the long bull market of cheap money and expanding valuations won't protect wealth when the tide reverses with force. The Federal Reserve's response to this crisis will be predictable but ultimately futile. They'll attempt to rescue the financial system through massive quantitative easing, creating bank deposits and reserves at an unprecedented scale. They'll be trying to support asset prices, finance Treasury issuance, and prevent a complete systemic collapse all at once. What they won't be able to control is the consequence of this monetary expansion, a severe deterioration in the dollar's purchasing power. China has been preparing for this eventuality for years, systematically reducing exposure to Western currencies while accumulating gold. The Shanghai Gold Exchange establishing vaults in Hong Kong and Saudi Arabia isn't a random development. It's infrastructure for a new monetary architecture that will emerge when the dollar's decline becomes undeniable to everyone. China won't precipitate the crisis. They don't need to. American policy is accomplishing that without assistance. But when the moment arrives, they'll be positioned to offer the yuan as a trade settlement currency backed by substantial gold reserves, a modern version of Bretton Woods that leaves the West on the outside. The political reality in Washington, London, and Brussels is that no leadership group is prepared to make the difficult choices that might change this trajectory. Balancing budgets, reducing government spending, withdrawing from economic intervention, accepting the pain of structural adjustment. These options aren't even being seriously discussed. The entire establishment operates within a Keynesian framework that fundamentally misunderstands money and credit. Even if they comprehended what was happening, political constraints would prevent meaningful action. History shows us that currencies collapse not because solutions don't exist, but because implementing those solutions is politically impossible until it's too late. What distinguishes 2026 from previous years is that gold is no longer just preserving wealth. It's actively signaling the coming destruction of purchasing power. Silver's dramatic move higher, driven partly by China's decision to restrict supply, points to a broader reassessment of commodity values. Base metals are catastrophically undervalued relative to gold, priced at perhaps 20% of their historical relationship. The mathematical implication is stark. These materials need to quintuple in price measured in gold terms just to return to normal. Translated into depreciating fiat currency terms, the numbers become staggering. Energy markets face similar dynamics. Oil may seem oversupplied today, but measured against gold, it's extraordinarily cheap. As the dollar's purchasing power deteriorates, commodity prices don't rise because commodities become more valuable. They rise because the measuring stick has shrunk. This is the inflation that central banks aren't discussing and that most investors aren't prepared for. It won't show up immediately in consumer price indices, but it will manifest in the raw materials that underpin every industrial process and every manufactured good. The confluence of collapsing currency values, surging commodity costs, and counterproductive trade policies will create an economic environment unlike anything most market participants have experienced. The speed of deterioration, once the process begins in earnest, may shock even pessimists. Financial assets tied to credit instruments face existential risk, a journey toward valuations that could erase decades of nominal gains in a matter of quarters. Silver's surge carries an additional warning that specialists in derivative markets understand with growing anxiety. Counterparty risk in over-the-counter precious metals trading, particularly in London, could spread contagion across interconnected financial instruments. When the same institutions handling commodity derivatives also deal in interest rate swaps and currency forwards, a problem in one market quickly becomes everyone's problem. We're standing at the edge of a precipice, and most people are focused on the scenery rather than the drop. The transition from the current system to whatever emerges afterward will be painful and disruptive. Currencies that lose purchasing power rapidly eventually trigger behavioral changes among their users. When people realize that money is declining in value rather than prices increasing, they stop saving in that currency and start converting liquid assets into physical goods regardless of immediate need. This flight into real assets represents the death spiral of fiat currency, and we're likely to see early manifestations during 2026, with full expression possibly extending into 2027. Understanding the distinction between money and credit becomes crucial for preserving wealth through this transition. Under traditional common law principles that central banks themselves still respect, money is gold, possibly silver, but primarily gold. Everything else, regardless of what governments declare or economists theorize, is credit. Credit carries counterparty risk, and in a systemic crisis, that risk materializes comprehensively. The opportunities that exist during this transition lie in the physical commodity space rather than financial abstractions. Industrial metals, energy resources, precious metals. These tangible assets will maintain and increase value as paper instruments fail. The technology darlings, the momentum plays, the speculative bubbles that have characterized markets for years face a potential 90% drawdown that would merely return valuations to historical norms relative to underlying economic reality. Global trade has already been severely disrupted by inconsistent American policy that oscillates between protectionism and openness without coherent strategy. Relationships with China have deteriorated to the point where Beijing has made strategic decisions to protect its resources and reduce dependence on Western markets. The rest of the developing world has watched how America exercises its currency privilege, the coercion, the sanctions, the regime change operations disguised as humanitarian intervention, and concluded that alignment with the Western system is a vulnerability rather than an advantage. Europe faces its own existential challenges, with political leadership that has completely lost coherence and competence. Britain pursues economic policies rooted in ideological fantasies rather than practical reality. The Eurozone's governance structure is failing under the weight of its own contradictions. These economies will not collapse independently. They'll be pulled down when the dollar falls, because the entire edifice is interconnected and depends on dollar stability. When that keystone fails, the transatlantic financial architecture falls with it. The tragedy is that none of this needed to happen. Sound monetary policy, fiscal restraint, respect for property rights, and non-intervention in foreign affairs would have created a very different trajectory. But those choices weren't made, and we're now dealing with the consequences of decades of accumulated mismanagement. The bills are coming due, and they'll be paid through inflation and financial destruction rather than responsible adjustment. For individuals trying to navigate this environment, the imperative is clear. Wealth stored in conventional financial assets faces severe erosion. The comfortable assumptions that governed investing for the past 40 years no longer apply. Protection requires moving away from paper claims and toward tangible assets, particularly gold, which isn't just an investment, but insurance against the monetary chaos that approaches. Those who fail to recognize the shift in time will discover that their lifetime of careful savings has been diluted to a fraction of its former purchasing power. The signal from gold prices throughout 2025 wasn't noise or speculation. It was the leading edge of a massive repricing that will dominate 2026 and beyond. The question isn't whether this transition will occur, but whether investors will position themselves appropriately before the majority recognizes what's happening. By the time protective measures become obvious to everyone, the opportunity to implement them effectively will have passed. This isn't about predicting specific price levels or exact timing. Those details are unknowable and ultimately irrelevant. What matters is understanding the direction and magnitude of what's coming, a fundamental breakdown of the current monetary order, and a redistribution of wealth away from paper assets toward real things. The mechanisms are already in motion, the timeline is compressing, and the outcomes will reshape the economic landscape for a generation.